In this video we are going to talk about the Realty income stock. So before starting, please like this video and subscribe to our channel for future updates. Realty Income Corp. NYSE Smiley Face is arguably the most well-known real estate investment trust in the world. Long before monthly payouts became trendy, the company ingeniously positioned itself as the monthly dividend company. Since then, investors have been flocking to O shares. The company has a lot of followers because of its consistent monthly income and outstanding performance. Retail problems. Realty Income has a wider range of investments than many of its competitors. We're not talking about a low-end mall, right? Nonetheless, Realty Income has made significant investments in properties whose tenants are primarily brick-and-mortar retailers. Yes, several of their top tenants are less exposed to Amazon.com, Inc., such as Walgreens Boots Alliance Inc., Nasdaq, WBA, Dollar Tree, Inc., Nasdaq, DLTR, Walmart Stores Inc., NYSE, WMT, and CVS Health Corp., NYSE, CVS, Nasdaq, AMZN. Realty Income is a real estate investment trust, Reit, with a number of positive attributes, NYSE Smiley Face. Valuation isn't usually one of them. However, with the stock down approximately 20% from its early 2020 highs due to the coronavirus epidemic, it's worth digging further to see if Realty Income is a buy or not right now. The name to keep an eye on. Realty Income has become a bellwether in the net lease space, with approximately 6,500 properties. Single-tenant net lease Reit's-owned buildings where the renter is liable for the majority of the operational costs. Realty Income makes the difference between its rent rates and its cost of capital, making it a low-risk approach in the REIT industry. And Realty Income, which is rated investment grade, has a cheap cost of capital, which it locks in through debt and stock transactions. The stock sales are the thorn in the investor's side. The issue isn't dilution, which investors must consider when selling new stock, but valuation. The investment grade rating of the REIT allows it to issue financing at low interest rates. A high valuation, on the other hand, means it can issue stock at a premium. Yield is a simple indicator of a stock's capital cost. The current yield on Realty Income is around 4.5%, which is around average over the last decade but around the bottom end of its historical range. As a result, the REIT still has access to relatively low-cost funding. This is beneficial for Realty Income's business, but it also indicates that investors should be cautious about valuing the stock. Even if the stock has dropped by almost 20% in the last year, it is difficult to argue that Realty Income is currently undervalued. Here are some numbers that will assist you. In the third quarter of 2020, the REIT's adjusted funds from operations, AFFO, were 81 cents per share. Using that as a benchmark, Realty Income's price to AFFO is roughly 19 times. That's a big figure for an income-oriented investment with a reputation for modest and steady development. Worth the price of admission? Simply said, even at today's pricing, value investors are unlikely to enjoy Realty Income. Those trying to increase their earnings will most likely discover better possibilities as well. However, Realty Income is a leading net lease REIT for a reason, and this merits more analysis. Realty Income, for example, has increased its dividend for 28 years in a row. Because of this, it is classified as a dividend aristocrat. Moreover, despite the pandemic challenges, the streak includes a minor gain in each quarter of 2020. Realty Income appears appealing to investors looking for a dividend-paying investment that has proven itself in both good and bad markets. In the meantime, the average annual dividend rise over the last decade was slightly under 5%. That's not a lot, but it's more than the typical pace of inflation increases, which has been around 3%. As a result, even while the yield isn't as high as some other companies in the same space, the purchasing power of the dividends has increased faster than inflation. This is yet another benefit. Then there's the dividend payment schedule. Realty Income's dividend is paid monthly rather than quarterly, as is the case with most companies. That makes it very close to receiving a paycheck, which is likely to appeal to retired investors. So, all in all, for conservative investors prepared to pay out for an industry leader, Realty Income's 4.5% yield might be worth the price tag today. Truthfully, the REIT doesn't go on sale very frequently, and 20% below the early 2020 peak is a fall worth checking at. Stock pros. There's no denying it. This is a huge historical performance. Realty Income has been a star performer in the REITs category, returning almost 17% per year compounded, including dividend, since it listed on the New York Stock Exchange in 1994. The corporation has paid 562 consecutive monthly dividends without fail, and its dividend has raised for 78 straight quarters. That is an outstanding performance. Any company that generates annualized returns of 17% is doing well. It's especially impressive coming from a company with such a strong dividend and tangible assets to back up its value. More diversified tenants. As previously said, American retailers are panicking. Many mall REITs are down 40% or more over the past 12 to 18 months. Amazon appears to be obliterating clothing and department stores at a higher rate than ever before. Due to its tenant base, Realty Income is somewhat immune to this, at least in the short term. The company has little exposure to large box tenants like Sears Holding Corp., Nasdaq, SHLD, which are putting mall operators in jeopardy. Realty Income, on the other hand, is exposed to a broader range of businesses than Amazon, including dollar stores, movie theaters, logistics operations, and convenience stores. Realty Income is still dealing with long-term challenges as a result of digital competition, but there is no immediate danger. Long leases. Throughout the financial crisis, Realty Income performed admirably, with occupancy never dipping below 95%. It outperformed the majority of retail-focused REITs. A large part of this is due to the company's policy of tying retailers into long-term contracts. The average length of a new lease signed by the company in 2016 was 14.7 years. Given the current difficulties in the retail sector, this is fantastic news. Realty Income can safeguard itself from departing tenants and/or dropping rental prices in the short term by locking up long-term contracts. This provides O with a lot more options as it navigates the post-Amazon physical retail scenario in the coming years. O stock cons. Interest rates on the rise. Any discussion of REITs must begin with the big questions. How much higher will interest rates go? How much will REITs be impacted? Short-term interest rates in the United States have remained essentially unchanged since 2009. REIT prices have risen as a result of this. This is due to three factors. First, as interest rates decrease, the value of a real estate company's properties rises since cap rates fall. Second, REITs can borrow money at a lower cost, lowering their interest costs and increasing FFO, dividends, and deal-making ability. Third, given the scarcity of safer yield options, investors will accept lower dividend yields, and thus higher stock prices, for REITs. As interest rates rise, all of these beneficial impacts reverse. As investors seek higher cap rates, Realty Income's buildings lose value. Due to Realty Income's large debt load, refinancing will require higher interest rates. And the company's dividend yield will rise. A mere 0.5% increase in interest rates would likely cause O stock to have to yield 5%. It yields 4.5% now. Such a move would cause the price of O stock to fall from $55 to $50. But less exposure doesn't mean that they are entirely in the clear. As the recent news about a potential Amazon pharmacy reminds us, very little is safe from e-commerce at this point. In general, the United States is already one of the world's most overbuilt countries for commercial retail space. Even if Realty Income's tenants hold up well, the flood of failing retailers will cause overall rent rates to decline as vacancies pile up. Still expensive. No matter how you cut it, O stock still looks expensive both against peers and its own past history. You can get retail-orientated REITs with decent properties trading at far cheaper multiples today. Sure, Realty Income has earned a premium with its reliable performance over the years. But arguably the share price is still too lofty here. Consider the dividend. Over the past 13 years, Realty Income's historical median dividend yield has been 5.1%. The majority of that span fell during the zero interest rate years. And yet now, with interest rates on the rise, O stock yields just 4.5%. This will easily move to 5%, or even, perhaps, 5.5% given a couple more Federal Reserve rate hikes. O stock could hit 50 or even the high 40s to account for that new interest rate reality. Verdict on Realty Income. Realty Income's track record speaks for itself. If you can acquire O stock at a fair price, it's a great buy and hold investment. However, that fair price probably isn't $55. The 4.5% current dividend yield simply isn't high enough, especially considering that Realty Income's long-term median yield is 5.1%. Given the likely trajectory of interest rates, we'll probably see O hit $50 later this year. What are your thoughts on our video? Please let us know in the comment section below. If you enjoyed this video and would like to hear from me again, please subscribe and turn on the notification before leaving. Thank you for watching us.